All right, I'm back. Well, I guess you wouldn't know that I'm back, but I took a pretty significant break from chapter 4 to today. I was panicking. Well, I wasn't panicking, but I was frantically trying to record all of these lectures for a class that was supposed to go last semester. And so I was scrambling to try to put everything together. Then the class got canceled, so I stopped recording videos for a while. But I'm back because another class is picking up soon, and we're using this book, so it's time to get started. Unfortunately for you, I haven't gotten much better at making this stuff entertaining or interesting, any more entertaining and any more interesting than it's ever been. And I can't say that my video recording skills have gotten any better. I'm definitely getting more comfortable, but I still use or I still pause too often, use the word like too much, say too often, say right too often. I've been watching some of my earlier recordings and I'm horrified by the way it sounds. But anyway, Chapter 5 of the McGraw-Hill textbook, Cost Behavior and Cost Volume Profit Analysis. In my opinion, this is one of the best chapters in any of the classes that you're going to take, whether it's financial accounting, managerial accounting, your econ classes. I really like this chapter. There's so much that you can do with the tools that we're kind of uncovering in this chapter in real life. So yeah, it's a good chapter. I really like it. All right, so what we're going to try to tackle in these or in this chapter, first one is we're just going to try to talk about the cost behavior. So this chapter is all about really identifying and 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 estimating the cost of things as our production increases, right? So again, there I just said right. So I'm gonna try to not say right ever again, at least in this video. But anyway, um, what we're saying in this chapter is that as our production increases, so if we're making tables, as we are producing more and more tables, the total cost of production is going to go up, right? Fuck. So anyway, I guess I'm never going to get rid of that term. Just gonna fucking right are probably the two most common words that I use in these things. Anyway, um, if we are making tables and I make 10,000 tables and then in another period, I make 75,000 tables, I think we would all agree that I'm going to incur more costs when I make 75,000 tables as opposed to 10 because I need to purchase wood and paint and glue and nails, all of the things that go into making tables. So obviously, the more tables that I make, the more wood I'm going to need. The more wood I'm going to need, the more it's going to cost, right? So this chapter is really getting at how do I estimate or how do we measure the costs as our production increases and decreases? And the first thing that we really need to get a handle on is this idea of fixed costs versus variable costs. So that's like the first thing we're going to cover in the next video. Then we're going to really talk about applications of cost volume profit analysis in the second video, but we're definitely, I guess my pen isn't working. We're definitely going to want to talk about how do we estimate costs and so forth. Then down here, we're going to start talking about contribution margin and what that is. It's a new term. It's nothing terribly difficult, but it is a new term and it's a new tool and it's something that's going to provide an immense amount of value to us. Being able to compute the contribution margin is going to unlock all of these really cool things in business. Like, how do we think about adding a new product to our product mix? Um, How am I going to cover my fixed costs? We'll talk about fixed costs. How many units do I need to sell in order to break even? All of that stuff sort of starts with the contribution margin. So we're clearly going to go through that. Then we're going to talk about how much profit am I going to make under various operating levels, right? So again, if I'm making 10,000 tables, how much money am I going to make? If I'm making 75,000 tables, how much am I going to make? All right. And then we're going to talk about scatter graphs and scatter diagrams, cool stuff. We're going to talk about break even point. Again, that's how many tables do I need to sell and make in order to cover all of my costs? You know, the break even point. Really, really interesting stuff. And we're going to do, most companies, they don't just make one product. They make, if I'm making tables, maybe it's likely the case that I'm also making chairs. So if I'm selling tables and selling chairs separately, how many tables and chairs in total do I need to sell to break even? The analysis is pretty easy if I'm just selling tables, but when I start introducing additional products, the break even point it becomes a little bit more complicated. So we're going to talk about how do we address the break even point when we're selling multiple products. And then unfortunately, we're going to go all the way down into the appendix and we're going to talk about the difference between absorption costing and variable costing. But the entire chapter really revolves around, the next video, which is the differences between variable costs and fixed costs.